You're watching economic data to give you some sort of indication of where we're headed.
Right. We've been in this very risk-on upward equity market since mid-October, and I see that there's a little wavering, a little more hesitance coming on, particularly just even with today's action. It's not surprising. So I think we're going to see more of a balance between risk on, risk off, so up days, down days, up until that December meeting. Now, certainly, if the December meeting turns out well, if there's really good commentary, we could maybe have that Santa Claus rally in the very last 2 weeks. But I think there's a lot of risk. And so I think in December, we should be very cautious and very aware that valuations are a little stretched. We're hitting peaks that we saw earlier in the third quarter. And considering how much earnings are being revised down for next year, I think if that risk off, if that fear sentiment comes back, we really need to be prepared and have some defensive positionings for the next month.
Where do you stand on the U.S. consumer, given that we're headed into holiday season? Can they outspend the inflation rate right now?
Certainly they can. I think it's just that they're not going to perhaps hit some of their targets, particularly with retailers. And it really looks different when you look at different sections of the consumer, consumer durables versus discretionary. While we'll probably get some disappointing numbers, and it looks like we're going to get some disappointing numbers for December within the retailer section, services looks extraordinarily good, particularly going into next year. So hotels, restaurants, experiences, Booking.com is one of my favorite stocks. Those types of consumer discretionary are doing very well, but I think we are going to see some disappointment within the apparel sector.
Yeah, how enduring do you feel the consumer is going to be, though, heading through 2023 and beyond? Because there is more Fed tightening coming, and we've just had a Bloomberg survey out that says, well, more than half of investors are now worried about stagflation risk. Is this something that concerns you?
Certainly. I mean, obviously, we're looking at potential of recession. We still have that inverted yield curve, and the U.S. consumer holding up the broader markets. And when you look at consumer durables as well as consumer discretionary as just a full broad market, we have seen big downward revisions. In fact, earnings growth for 2023 has already been cut by about 1/3. Or the growth rate has been cut by 1/3 just in the past 6 weeks. So I think we are going to see, in general, more slower spending. What I'm talking about really, though, is that within consumer discretionary, if you really drill down industry after sub-industry, one area that we do see actually being revised upward, surprisingly, is hotels, resorts, restaurants. Those types of stocks are doing extremely well.
How about if you look offshore, say I'm thinking of China particularly, a rather rough ride is expected as that country exit COVID. We've seen a lot of protests over the weekend. Is China investable in the near term?
No, I think we have more conservative clients, certainly, but I think it's a heavily, very risky investment and not necessarily seeing the upside. Right now we're facing the risk of a global recession, and certainly China is one of the main components of that. And so I think until we see clearer signs of not only political stability and certainly less protest, but just meeting those growth targets, certainly some of the risk factors in the real estate area either flushing out or being resolved. I think that's one area that I feel the risk reward ratio just isn't there. There's just too much risk for the amount of reward, especially considering how much risk in general we're facing across, at both developed and undeveloped markets.
No wonder the bond market is anticipating a less hawkish Fed. Are there any opportunities there?
Yes, so certainly within the Treasuries, though we have seen some wavering, the rates are still going down and they're heading down. So I think we're a little late certainly we are a little late in the cycle of those rates going down. But if the Fed again continues to reassure investors that they are seeing lowered inflation. And I think the PCE indicator and the GDP, some of the macro reports that are coming out of the next 2 weeks are going to give us a good sense of how that meeting is going to go. You can use that. So, going directly into U.S. Treasuries as the rates drop, that particularly within the 10 to 15-year range, you get sort of the most bang for your buck for the prices going up, and you're seeing those prices going up while the rates are dropping. Like I said, we're seeing a little bit of wavering and a little, days of risk on, risk off. So it's, more of a time to be a little nimble within trading. And you can use some of the leverage products out there to certainly help you leverage some of the moves as we try to guess what the Fed's going to do in about 3 weeks.